Good morning, everybody. Hey, it's Mark Johnson at Rate, and just grateful to be here today. We have some volatile interest rate swings. Last week, we saw interest rates kind of go up and go down, and one of the reasons for that is that we're looking at some pressure because of Trump's tariffs threats, and um, that caused the market to swing wildly, and we had interest rates that went up last week. But then towards the end of the week, things started to moderate, and things are better this week. So let's kind of take a look at where we're at right now. Over the last week, interest rates came down a little bit. The national average is 6.63. Here is the jobs report that helped us a lot from keeping rates from going even higher. The main thing here with the jobs report is that they created 151,000 jobs. Those usually get revised the next month, but it was in line with expectations. But one of the things that the market really moved on was that hourly wages went down almost 3% here. And so last month it went down 0.3%. And year over year, it was 4% in January, and then last year in 2024, and it's 3.9% this year. Originally, it was forecast, or it was revised, or the amount was 4.1%, and then they revised it down to 4%. So, technically, this could be maybe even a little bit lower when they revise it. It just seems like the government's always revising things a little bit lower. They're kind of hedging their bet, if you will. But the hours worked, that's the key here, is the hours worked was only 34.1%, which is a 15-year low. And the other thing is the weekly average is 12.25, which was up 3%. So it seems like the media takes these numbers and they want to use it for news purposes. And so they're saying, hey, wages went up, when in reality, the number of hours went down. So the income actually really didn't move very much at all. So let's take a look at the interest rates themselves here. If you look at the 10-year Treasury, you'll see that it went up, and then finally on Friday, it got a little bit better. And then today is a little bit better. And some of those reasons why is because Jerome Powell came out. One of the reasons is Jerome Powell, who's the Fed chairman, came out and said that he expects that inflation will continue to go down. And he still expects it to be somewhere around 2%. And it might take a little bit longer than needed, but that based on the numbers, he doesn't see that that's really going to be a problem. Now, a lot of people are crying, hey, we're going to go into a recession. Reality for interest rate is recession is good because that'll bring rates down even more. But, whether we go into a recession or not, it's really, really going to be hard to say. The other thing that came out today was the CPI number. You'll see that the CPI number, well, these numbers haven't come out yet, but this is what the forecast is and what they're expecting. And it should come out sometime, maybe Wednesday, I believe. And the forecast is that the CPI should be going down from 3% in February to 2.3%. So that's a big difference from last year. And then the replacement, it was a 4% last year in February, and this is down 0.3% from January. And then you look at the energy. This is a big, huge thing. They're expecting energy to come down by 6%. And then the core inflation, which is looking at things that are volatile, basically. You're looking at they're forecasting at 2.7, which was down from 3% in February, and then the replacement cost is down 0.37. And so the year over year, this is what's important, is that last year it was 3.3%, and then this year it's going to be, they're hoping that it's going to be somewhere in the neighborhood of 3. The core inflation, let me just get this a little bigger here. It's going to be lower, and then shelters, they're hoping that that's going to be lower than last year. They're expecting 4.3%. It might just be the same anyway. So let's go ahead and for a second look at what the bond market's doing. You see that the bond market didn't move nearly as much as the 10-year treasuries. And this is where we buy our money. And so when this goes up, interest rates go down, as you know. And so, today we're seeing, kind of this, this ceiling of support here. Hopefully we can break above that. The 10-year treasuries, they did break ahead, on top of that. And so we think that interest rates really are going to start coming down. And I would probably float right now if I was starting my application with and maybe seeing where the actual numbers come in. Now, it's a dice. So, I always say, you could float right now, but I always tell people, lock in right now. If rates do come down quite a bit, in other words, if it comes down more than 0.25%, then we can always renegotiate your rate and get you a lower rate. Today's market rate watch comes to you from, you don't need 20% down. That's we just want you to know that you can get a home with less than 20% down. You'll have to pay PMI or the government loans that are out there. VA is no PMI, but there's a VA has a funding fee, and if you're disabled, even just 1% disabled, you don't even have a funding fee. So for conventional loans, if you've got good credit, boy, you could get in for first-time home buyers at 3% down. So if you have any questions about these or anything else, give me a call. Hey, thanks for listening, and we'll see you soon.